Hi everybody, this is Chris Sear with another addition to our Sear Financial series of educational videos. They're meant to be practical and useful for you to use. Today's video is an excerpt from our most recent investment committee meeting, and it highlights the key differences between strategic and dynamic investing. We believe that this concept is one of the most critical in understanding how you can invest your money. I hope you enjoy. Okay, on the screen what you see here is basically the essential building blocks of a portfolio. Stocks, bonds, real estate, gold. There's really more than four, but this is just a visual. And I want to talk to you guys about strategic asset management. So what strategic asset management is what we are not. So this is what is usually followed by the typical retail investment advisor. And so it's also known as buy and hold, static, traditional, passive index. They're all the same. What they mean is that a client goes to an advisor and the advisor asks them a few basic questions. They fill out a necessary questionnaire, and based on the way you answer those 10 questions, an advisor will put you into a strategic or buy and hold portfolio. And what you see on the screen here is that in the first quarter, you'll be allocated however your advisor thinks you should be allocated. And then next quarter, you'll see literal no change. And in fact, a lot of videos we put out there show that most clients that walk into Sear Financial office, when we look at their statement that they've given us and compare it to the statement they had 5, 10, 15 years ago, exactly nothing has changed. And that is what 95% of retail financial advisors are doing, okay? By the way, what they are doing is what's been taught for over 100 years. So in 1900, there's this French guy, a mathematician. He basically writes his thesis, the theory of speculation. What he says is, speculating is useless. Whatever you know about the price of gold is the same thing that Andrew knows about the price of gold, is the same thing that Ian knows about the price of gold. So don't think you know more than everybody else. Speculation is a worthless cause. And we have this efficient market, and you're not going to make any more money than your neighbor because you're not any more wise. You have no more or less information than your neighbor. It's written in French, so it's highly regarded, but is not translated and nobody pays attention to it. In 1950, the US gets involved, and this guy named Harry Markowitz comes along with the modern portfolio theory. He basically agrees. He says, you know what? Everyone's going to get the same portfolio. If you're an old person, you're going to get a 4% return, and you're going to have a very conservative allocation, and that's the way it's going to be, and you're going to get a 4% return. And if you're a very risky investment person, you're going to have a risky portfolio, and it's going to have more stocks than bonds, and you're going to get a 10% return. That's just the way it is. The 1900 mathematician, his work finally gets transcribed into several languages, including English. And a man named Eugene Fama, almost 60 years later, says, yeah, there's some value to that, and I'm going to call it the efficient market hypothesis. This is what is taught for over 100 years at every single university. So when I went through the finance program at the University of Illinois, Chicago, I was taught about the efficient market hypothesis. It's all the same thing. It's basically saying just do something and never change. By 1970, we get the computer involved, and these companies are getting wise about how to make money, and they're basically packaging these ideas of the last 50 or 60 years. And by 1970, there's 360 mutual funds, and there's $48 billion sitting in mutual funds. But then there's a guy that invented a company called Vanguard. He had an idea in 1974. And he said, you know, all these mutual funds are terrible. They include expenses. None of them outperform the benchmark, and I can give the investor over a long period of time a better client return. Today, by the way, Vanguard has 5 trillion assets. And today there's over 9,000 mutual funds with $19 trillion. So the mutual fund industry is now starting to, for the first time, shrink for a lot of reasons. One is expenses, one is underperformance, but we're talking about here today is another reason is there's a lot of new research coming out that says this strategic asset management doesn't make sense. So we're going to talk about the opposite of that now, dynamic asset management, which is what we follow. There's additional colors here. I like to use colors. I like to point. You can see that there's still the same building blocks, stocks, bonds, real estate, gold, etc., etc. But there's an additional layer. And what we have here is what we call sleeves. These sleeves change based on computer-generated models, based on what we're seeing in the markets, based on what is happening, based on our own subjective opinions. And so while we, too, if you look at the strategies and the blue circles, our strategies are still basically not changing quarter over quarter, year over year. However, because these recipes or sleeves, by their nature, change, actually what our clients are seeing down here in the bottom right is a true change in their portfolios. Why are we doing this? So this is my favorite slide. I show every single person who ever even pretends to have an interest in investing. If I show them one thing, this is the slide. This is the stock market, 30 years and 30 seconds. Love this slide. Okay, so January 1989 to August 2000, we're talking 12 years. The stock market turns $10,000 into $68,000. A lot of fun, real easy. However, in the next 25 months, basically you lose almost half of everything you had. You worked so hard for 12 years, in 2 years, half of it's gone, just like that. Then we go on a run of 5 years, and you basically get back, maybe a little higher than where you were. And then we have the most recent downturn, which lasted only 16 months, and you lost half of what you had. And this is a little dirty secret that's not very well shared, but known within the investment industry, is that this is known as the lost decade. So you see $37,000 in basically from 2000 all the way to the end of 09, you basically made nothing. In fact, after fees, after paying your advisor, after paying the mutual fund companies, nobody made anything for 10 years in a row. The only people that made money were investment advisors and banks in this time. And then, of course, we just got done with our longest bull market history, 9.6 years. So this is turning $10,000 to $184,000 in 30 years. That's the stock market in a nutshell. So we're not going to talk about the Dynamax today very much and the multi-trend. So our internal strategies, about 45% of what we're investing in are in these two strategies. We will do learning sessions on these another time. But what these strategies do is they move in and out of asset classes based on models. So I'm looking at the first down period from 2000 to 2002. That downturn, the stock market went down 45%. Our Dynamax went down 4% in that same time period. And if you pull up the chart there, Tyler. So what's interesting about this, there's your 45%. This is the stock market. This is the Dynamax. One really important thing, and Terry and Roger, if you look at the graph, at the left-hand side, the red would be the Dynamax and the blue would be the stock market. And what's very important about dynamic asset allocation is that it's not perfect. It does not pick the top of the market on the exact day it reaches the top, and it does not pick the bottom on the exact day it reaches the bottom. What it does is it says, hey, dummy, something is happening here over the last month, over the last 2 months. Each investment philosophy uses different triggers, but you can see for the first basically year, you can see that the red line, the investment strategy, the dynamic investment strategy, follows the blue line down, okay? This Dynamax, for example, basically broke even in 2018, okay? But in the last quarter, when the stock market had its worst quarter since 2011, this Dynamax lost almost 16%. And so the point of this chart is to show you that even though this is some great strategy perhaps, on day one, when the market started going down, it takes time for it to realize that something's going on. Okay, we can go back. Okay, and then the Dynamax in the second drawdown period, when the market went down 50%, went up 55%, And the multi-trend, which is another indicator, another strategy we use, went up 26%, 31%. So what's the point of this chart? Well, these are really good, amazing returns in a time period when the stock market just absolutely got killed. So let's suppose for a second that we can't get 50% return when the stock market crashes, but let's assume that maybe we could just break even. And if you just try and do that over the same time period, you would have $675,000. And this is the end of my most compelling story. When I found this out 10 years ago, it changed it changed my career and changed my outlook on how to look at investments, and it made me want to do what we're doing here today. To me, this is compelling. This is very compelling, and that's really where we get started.